Plan for the worst, hope for the best. Underpromise and overdeliver. Measure twice, cut once. What do all these sayings have in common? They're about building in margin for error, which we do a lot in our retirement planning. Margin for error is everything. So the goal isn't to create a perfect retirement plan. Rather, it's to create one that provides flexibility to navigate whatever the world will throw our way. A retirement plan should be a living, breathing document. It should adapt over time. Under the current plan, you can see we have a 49% probability of success. Now you can see here on the proposed side, we've got a much better retirement score at 80%. Now, when your retirement plan doesn't work out, you've got a handful of ways that you can increase the confidence score. A lot of this will be adjusting your spending in retirement, maybe saving a little bit more while you can. We could downsize in the plan and utilize some of the equity to bolster your portfolio, change your Social Security timing plan. But what happens if markets don't behave exactly how we want it to, or Social Security ends up getting cut by 20%? That's why we need to stress test the plan to see how resilient it is. So we can see, for example, if markets drop immediately, yes, it drops the percentage from 81 to 73%, but that's still a doable plan. Whereas if Social Security gets cut by 20%, that's gonna make a significant impact to that confidence rating from an 81% to a 66%. So we need to be flexible and adjust if something like that happens. In reality, these are kind of the worst case scenarios. More than likely, some of these will happen to some extent, but then on the other side, other things may happen that are good or work towards building a better retirement plan. Here's the thing, no advisor will know what your retirement will exactly look like, but the principles of living below your means, building a solid nest egg, planning ahead of time, and being flexible remain timeless. So if you're getting close to retirement, let's say within 5 to 15 years, ask yourself, has your plan been stress tested? Would your plan hold up if one of those variables happened? Markets perform worse than expected, inflation's higher, or Social Security gets cut. If that did happen, what changes would you make to succeed in your retirement plan?